Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is October, 21st, 2012 edition of Market Outlook. Well, everyone's been talking about the silver anniversary of the October 19th, 1987 meltdown, and there have been a number of market crashes that have occurred, and we're going to review the setups, try to step back, take a look at the weekly charts, look at the structure of the market. But before we do, don't forget to take our investment survey that looks at sentiment. And if you do, we'll send you the results. They've been quite interesting. And, we've only started over the last couple of months. And so the more history that we get, the more accurate we can get in understanding just how it works and how accurate it is. So far, we've had some interesting results from the survey, and Jeff, president of MarketGauge, assimilates that data and sends you that report by midweek. So, also, if you like what you see today, and you like the text version of Market Outlook, don't forget to sign up on the MarketGauge website, www.marketgauge.com. All right, so let's take a look. One of the things we're going to look at today is a weekly chart, but instead of looking at just the normal chart, which is a candlestick chart, it's often good to step back and try to filter out the intraday or intra-week vibrations by just looking at the closing prices, because oftentimes the where the market finishes for the week is offers a clean look at the data. So we're going to step back here. This is a weekly chart on the S&P. I've drawn in a number of different trend lines and channels. So the first thing, and this is going back to the lows in 2009, and let's take a look. So there's a bunch of things going on here which are quite revealing. The first thing you can see, number one here, that was really sort of the completion of what I would call the first big move up. And as you see, we've put in a trend line. This trend line is a valid trend line because we've had a series of higher highs, higher lows, and when we broke the trend line, obviously that move was broken. So a couple things and want you to notice here is, number one is this fanning action. So each time we've made some successive new highs and then broke through the trend line after those highs have been made, you consider that fanning action, which is quite classic. After three or four fans or trend lines that have been broken, generally that would signify the end of the trend. So move one was in the early part of 2010. You made a new high. Also, notice the volume as we made that high off the move from the economic meltdown in 2008, 2009. Okay, move number two, wave number two before it broke down was in the spring of 2011, and again you can see that the volume was actually less than the volume in that first wave. Then we broke down. Now this is interesting because this particular pattern here on this particular wave, 1, 2, you actually had a 3-point trend line, and then it broke down again. And notice, of course, on the declines, you've had massive volume. And then in this spring of this year, you actually had another high on much lighter volume yet again. So on that particular high, that lower volume, you actually did not have that fanning action that you would have looked at and said that that wave has been broken. So that wave is still intact because as we made the new high, right, the big line off, the big trend line off the lows is still intact. So that's a positive sign. Now, within the wave structure that you've looked at here, you also have what I would call this channel that's been developing that started in 2010. And this is, I've highlighted these and made the important channel and trend lines the heavier weights. So in this particular case, you can see that the primary channel, right, stops somewhere around 120 in the S&P. At the same time, we're trading at the upper end of this particular channel. Now, there's no saying that we can't obviously keep on popping and moving basically through or up and around the upper end of this channel, but we are running a bit rich at the higher end of the channel, which does not mean that the move is over. It just means that we are at the upper extremes. Now, we can also still correct, and if you look at the blue line here is the 65-week moving average, which coincides with that primary trend line here. So we've got the trend line, we've got the bottom of the channel line, and this should actually act as really good support. So sure, could we sell off another 5 or 6% in NASDAQ? In the S&P? Absolutely. However, a couple things to note. We have a rising 200-week and a rising 65-week. So at this point, between the still intact trend line, the overall ascending channel, this is all positive. Now, also, we have a very a shorter term upper channel line that you're holding right here. So if you're looking at it, and depending on your time frame, you really want to look at holding right here, which is really critical. On a weekly basis, you can see that we closed right on this upper channel line. So if we can basically hold here, I could see again another test of the highs. On the other hand, if we break down through that channel, certainly a test of the primary trend line off the 2009 lows is in order, but it should hold intact on the 65-week and that trend line. Further support under that, should we break, would be at this trend line here, which is somewhere in the 120 level, and ultimate support really sits somewhere around 117, 118 in the spiders. Okay, so that's your overview. Again, with all the hoopla about how the market has a crash coming, so far everything looks still overall intact. Are we definitely acting weak on a chart pattern basis, on a shorter term basis? No question that there is some weakness across the board, which means we could get that test. And let's see what the market tells us. But at least you've got the reference points to play off of. Let's take a look at some of the market internals now and sentiment. The first thing we're going to take a look at is the VIX. VIX, as you can see, is still trading within its Bollinger Band, both on a daily basis, which is right here. We're basically closed right on the Bollinger Band. So we did move above the 50-day moving average, but really we've been trading quite a bit around it, and it is declining. So I would sort of dismiss this as an important indicator for the moment. And really to focus on is the upper end of the Bollinger Band, as well as that 200-day moving average, which we're trading just beneath. So I would say sentiment is on the cusp of potentially generating a signal which would generate a sell signal for the market, but not quite there. So I would look at this as more neutral. And basically the outlook on a weekly chart, a longer term sentiment indicator, we're trading well under the 200-week moving average, a little bit above the 50-week, but still within the Bollinger Band. So again, sentiment across the board is what I would call more neutral than very positive. And certainly we're on a lookout to monitor this 200-day moving average. I mean, we had been trading down to 13 about 2 weeks ago. 1380. That was still within the range of normalcy, but positive. So sentiment was certainly not giving you any cause of concern. And again, in here, relatively neutral at the moment. Let's take a look at some of the market internals. Again, in this particular chart here, we're looking at the McClellan oscillator, which looks out about 3 weeks or so. It's using 39 days and 19 days worth of data. So that's good for monitoring the market for the internal strength for swing trades that are of duration of several days to a couple weeks. Right now, we're totally in the middle. We had just come off an overbought condition back in the middle of September. It worked itself off, almost got to a buy signal. You would say this was sort of a weak buy signal in here. However, the buy signal did come off of the shorter term indicators, which now are indicating slightly on a sell signal. We got a little bit overbought early this week, and we did that on the 10-day advanced decline, but not on the up-down volume ratio. We generally like to see those two together for more of a short-term signal. They really do not confirm, so you're in a situation where it's sort of what I would call a weak sell signal. And so you got plenty of room either way to move on the market internals. We just discussed the sentiment, and there you are, and that wraps up the section on market internals. I'd also like to cover one other thing, which are bonds. And I'm just going to move here to a daily chart on U.S. futures. I highlighted what I see as the primary situation with this market. You can see we have a downward sloping channel along with a slightly rising 200-day moving average, but a declining 50. And so you can see we've sort of been bounding through the channel as support, as well as the 200-day moving average, which coincided. Sort of held the market right here. But on the other hand, you can see that we do have a very good trend line, and as well as this declining 50-day. Now, also, just taking a look at the longer term trend, going back to April of 2011, you can see on the daily charts that we've been trying to test it. Again, it's this rising trend line. It basically was stopped. Just the decline was stopped just under the trend line, but held by the 200-day moving average. So your critical points to look for are that 200-day moving average. We violate that. The great bond bubble, and it certainly is, could be in the process of being popped. Now, if in fact we do have a further sell-off and weakness in the markets, I would expect that this market will bounce off of this 200-day moving average and potentially take out this particular trend line and the resistance level right here around the 150 level. So those are your two critical points around 146, 145 and a half in the futures market as critical support, the 200-day moving average, which if we break through there, we'll get a test of this lower bottom of the channel. On the other hand, if we hold here, I would expect another test of this declining 50, and all bets are off. If we can get through that 150 level, then I can see another run up to the highs. But again, running out of gas in this in the long bond. So that wraps it up for this week. Stay frosty because the markets are not stable at these levels. I could see some pretty violent action off those current ranges. So see you next week. And again, don't forget to take that investor survey and sign up for this newsletter to get it free every week. Thanks and bye for now.